Good morning, everyone. Uh, Thank you for joining on this Saturday morning. For the topic for today's webinar is comparing mutual funds with other asset class. So, the main reason for doing this topic is uh, many people are not aware on what they can do in mutual funds, be it through not only just equity mutual funds, be it through other asset class mutual funds as well. And it's mainly the main reason for this webinar to happen is to make people aware that they can do mutual funds even to their fullest potential rather than them sticking to very traditional investments. So we'll be covering all the advantages it has and what are the disadvantages and how we can structure your mutual fund portfolio across asset class, even for a small investor. So that's the main agenda for this webinar. So now let's quickly get into the webinar. So mutual funds is not only a better product just because of its returns. Many people tell that uh, put in mutual funds because it gives you 11-12%. Because other investments like FDs, your bonds, your real estate, everything grows around 7 to 9%. It's not only because of the returns, but it has other advantages as well. In terms of be it uh, you can start your investment even with a small amount, whereas when you go for other asset class investments, let's say typically FD, you need to start with a certain minimum amount. For real estate, you need to buy land at least for a few lakhs, even to buy a few hundreds of square feet. And even in gold, you need to buy it in grams or pounds. So, and even in selling, you have some constraints. But in mutual funds, all the buying, we can do it in small amounts and you can sell it for whatever amount you need in units wise. And there's a low cost barrier. So you can easily enter with the minimum amount, even with the 500 rupees, you can enter. And even in mutual funds, you can diversify across funds. Maybe in real estate, gold, you can't diversify. You need a huge sum of money to diversify. And also in terms of scalability, you can do an SIP and you can slowly invest and increase your portfolio size over a period of time. So apart from the returns, these are the uh, features it has which are better uh, for any investments. So this webinar is not to advocate that mutual funds are better than other asset classes. We generally advise you to follow a multi-asset investment, be it in mutual funds as well. So this is purely for how you can structure your investments. So that's the reason for this webinar. So, like I was saying, uh, comparing mutual funds with asset classes won't be the right question. It's not a right question. Because mutual funds is not an asset class. All asset classes can be done through mutual funds. So, mutual funds is an investment vehicle where most of them think that mutual funds is purely just equity mutual funds. You can do debt mutual funds. A lot of just like how a lot of stocks comprising is called as an equity mutual fund. A lot of bonds comprised are called debt mutual funds. The same goes for gold and silver and in international funds as well. So you can do most of the asset classes through mutual funds, be it in small amounts, and you can sell it easily. Whereas if you want to hold a bond, you can't sell it whenever you want. It's quite difficult because you can exit only at the time of maturity, or you need to sell it at a discount in the secondary market. And in terms of, let's say, gold or silver, if you want to sell it, and if you just want 10,000 rupees, you can't sell it for 10,000 rupees. Let's say you're having a certain grams, you can't cut it, or you can't, sell for that particular amount you want. So these are the advantages which MF mutual funds has when you compare it with gold or silver, uh, plain physical gold or silver, or a normal bonds. So, like I was saying, mutual funds is an investment vehicle. So, it's not an asset class. So, one of the other main characteristics is that, like, it's better in terms of diversification, because let's say if you're having your own portfolio, most of it will be very uh, concentrated, and in terms of a very concentrated portfolio, your drawdown should be quite high. Or let's say some of the people are very risk averse, they generally have more than like 150 200 stocks, they themselves run an index kind of a portfolio. So they're either too highly risky, or they're very low risk averse. They're both on the two extreme ends. Whereas in a mutual fund, in an equity mutual fund, there's a professional fund manager who is involved, and they know how to pick the stocks, and they position the stocks correctly in terms of position sizing and risk management, so that even if a few stocks fall down drastically, the other stocks will take care of the portfolio returns. So the risk adjusted return is quite better in terms of mutual fund investments, and your journey and will be also smooth. So the second thing and the most important thing is mutual funds actually democratize investing. Uh, because let's say a few decades back, you need to have, in terms of direct equity investing, you need to have a large sum of capital, and uh, things were not like how it used to be like now, where you can directly, instantly open a demat account in minutes. You need to go approach a broker, and you need a good, quite sum of money to get started. Whereas even in terms of other asset class investments, let's say real estate, you need a decent, significant amount of money to buy land, be it gold, silver. But in terms of mutual funds, the main advantage is that you can start your investment with a small amount of money, even with a 500 rupees SIP, you can start. So there's no need for large capital. That's one of the most important things of mutual funds. Mutual fund investments was around 12 lakh crores 5 6 years back, but after COVID in this last 5 years, we've almost grown 5 times. So the mutual fund industry overall is around 80 lakh crores now, and we are still, it's just a start. So there's a lot of penetration which will be happening. India is a around $2,900 per capita income country. uh, we feel that there's a lot more penetration which will be done in terms of mutual fund, insurance, or consumption oriented investments. And one of the most important thing is your money is accessible when you need it. Meaning, like let's say in terms of liquidity, right? You can easily sell, and you can get your money back in 1 to 3 business days. Whereas in a real estate, you know how things, uh, how a lot of time takes for you to sell that land actually, because the the time taken to get a buyer is very difficult, and the price you expect and the price they want to buy that land will totally be different. And similar goes for gold and silver investments. Let's say you need a particular amount of money, you can't you can't sell for that amount alone with the units you have. You need to sell the entire the physical gold or silver you have. So that's how it oftenly goes in gold, silver, or real estate. So it's difficult to sell those investments. Whereas in mutual funds, even if it's a gold or a silver ETF for a mutual fund you're holding, let's say you've invested 10 lakhs and you just need 50,000, you can just put the redemption for 50,000 in a gold mutual fund or a silver mutual fund, or even in a debt mutual fund. Let's say if you're holding a normal bond and the maturity is 2 years, and it's only the end of first year, and if you want to sell, you can't actually sell the FD. You need to sell it at a discount in the secondary market, or you need to wait for another year. But whereas in a debt mutual funds, there's no lock-in period, and you almost get the same returns compared to a bond, and almost the taxation is also similar. But these are the advantages it has when you compare it with the actual investment asset actually. Maybe in terms of ELSS funds alone, there is a lock-in period involved, which is 3 years, where you can't take it because you can get a tax exemption in terms of Section 80C for 1.5 lakhs for old tax regime uh, taxpayers. So, like I was saying, in mutual funds, your journey would be quite smooth, and you get a peace of mind. And it's better for professionals who actually look after their own jobs, where they spend a significant time, who don't have time to do their own research and investments. So it gives a better risk-adjusted returns. And when you compare it to the direct equity, direct stock investments, it's much more less volatile. And another thing is, like I was saying, it's just a product, it's just an investment vehicle, it's not an asset class. And in that investment vehicle, there are a lot of categories, there's a lot of strategies. You can have do you can have you can invest in equity mutual funds. Uh, like there's a lot of mutual funds in terms of even in equity itself. There's a large cap category, small cap category, multi cap category, small and micro cap category, multi asset, hybrid. uh, our mutual funds in India alone has around uh, there are around 3,000 to 3,500 mutual funds, and there are about 40 to 44 fund houses which are actually having these lots of categories in mutual funds. So another confusion is the investor needs to know which mutual funds to select out of these 3,000 mutual funds, and that's the reason why we are there. We can actually help you to take care of those things. We understand your risk appetite, your investment goals, your time horizon, and we select these mutual funds based on our team's research, and we help you to invest on the particular mutual funds on a regular basis, and we manage it, and we'll also let you know when to exit and rebalance and stuff. So like I was saying, there's a lot of categories in terms of a single mutual fund as well. So you can diversify across 5 to 6 mutual funds. So this is just a summary of the overall things we were discussing. So in terms of returns, I think in the slide it's given us 12 to 20, but on an average you can expect around 11 to 12% in mutual funds, in an equity mutual fund, because that's the returns which Nifty has delivered in the last 30 years. So 11 to 12% would be a right expectation setting for an investor who wants to stay invested at least for 5 year period of time. And for FDs, it's roughly in terms of 6.5 to 7.5%. And in gold, over a long period of time, it has delivered around 9 to 11% returns. And real estate, it is delivered around 8 to 9% returns. In terms of liquidity, mutual funds has the highest amount of liquidity, and FD, there is a lock-in period involved. So if you want to break it before that, you need to pay a penalty. And gold, the liquidity is higher, but you can't sell it in small quantities or small portions. That's the one constraint. And real estate, the liquidity is very, very low. And in terms of minimum investments, you can even start mutual fund with 500 rupees, and even in FD, it's quite low. And gold, in terms of physical, it's quite high, and real estate, it's very, very high. Then, out of all these things, the only thing which has professional management is mutual funds. So that's another advantage. And in terms of diversification, as I said, there was a lot of mutual funds in India alone. There are about 3,000 to 3,005 mutual funds in India alone, with a lot of categories across asset classes. And inflation, mutual funds, equity mutual funds, or even if you go for a multi-asset uh, investment, even in mutual funds, they generally beat inflation. And in FD, they deliver around inflation returns, and gold, they beat inflation by a small margin, and real estate also beats the inflation by a small margin. And in terms of regulation, very, very important. In terms of regulation, all the NAV, everything is correctly computed on a daily basis, and it's perfectly regulated by SEBI and AMFI, and FD is regulated by the RBI, and gold is regulated by our MCX, SEBI, and the government, and real estate it's regulated by RERA. So another thing is mutual funds awareness are coming, but a lot of awareness just goes to uh, small cap, mid caps alone. Everyone thinks just because of the high returns mutual funds have delivered in the last 5 years, they think they have 10-year horizon, 15-year horizon. So I just want to take the highest amount of risk, and I just want to go invest in small and mid cap funds. But that's not the only advantage the mutual fund has. Like I was saying, you can invest in small quantities in other asset classes through mutual funds. But a lot of people do this common mistake. They think mutual funds are only for equity investments, equity mutual funds. And even in equity mutual funds, I will take the highest risk and I will just go uh, blindly and invest in small and mid cap funds. And that was what it was happening in the mutual fund industry for the last 3 4 years. Every month, all the most of the SIP book of around 20,000 crores come as SIP book every month, and it gets invested in our Indian markets. And most of the amount of out of this 20,000 crore, it went to small and mid caps month on month, at least till Jan 2026. Jan 2026, a big surprise happened. And what the surprise was, uh, even more than equity mutual funds, a lot of inflows went into gold and silver ETFs and mutual funds. Why? Because gold and silver rallied a lot in the last 2 3 months, and investors thought it will rally even more, and they blindly invested. So most of the people are just chasing returns even in mutual funds, but that's not the right thing to do. You need to structure your portfolio uh, based on the correct asset mix. You need to follow asset allocation even in mutual funds. So the thing is, because you wouldn't have made returns, and you would have actually lost money. Your portfolio would be negative if you have invested only in small and mid cap funds in the last 2 years. Definitely, most of the investors' portfolio would be in minus. But let's say, for example, if you invested around 10% in gold and 10% in silver, and maybe 5 10% even in an international fund, definitely, and most of the other segments you just invested in, even in a large cap fund, definitely your portfolio would have made decent double digit returns in the last 2 years, CAGR wise. And right now, you could have just sold your gold and silver positions, and you could have moved it to short term debt funds, or you could have moved it now to small and mid cap funds, because the valuations have comparatively come down. So definitely, just because you want to invest for 10 15 years, and you want to take higher amount of risk, doesn't mean that you need to only invest in small and mid cap funds. That's definitely not the right approach to do mutual fund investments. So mutual fund investments, even though it's managed by a professional fund manager, even there is a well diversified investment approach, we need to be very careful on what funds you decide, and based on the market context and the market valuations. So another thing I just want to discuss is like every asset class are going down now currently. Your equity is going down. Your gold is going down. Your debt, the bonds might go down if the interest rate changes, because the inflations are going up due to this war crisis. There is a lot of geopolitical tensions happening, and the only thing is which is going up is the oil. And when oil goes up, obviously the USD will also go up. So what to do in terms of times like this? So the only thing is, uh, you actually, you just need to see this as an opportunity. This is not the time to, make returns. This is the time to position your portfolio aggressively for you to make returns for the next 3 4 years, at least till the end of the decade. So 2026 is a perfect year for you to aggressively position your portfolio correctly. So this is the time to set your portfolio, rebalance your portfolio for the next run. So this is how we see it. So you need to definitely invest across asset class. So you need to invest in equity where the valuations are very positive. I mean, valuations are fair or low, and you need to avoid certain segments where valuations are quite high, and you need to invest in a certain short-term debt funds, because short-term debt funds are generally not that volatile when interest rates goes up, and you can also use that as a liquidity when markets goes down even further. And you can also invest in a certain international themes where the valuations are quite cheap. And another most common mistake is most of the investors go completely 100% cash or completely 100% gold during times like this. And if you would have went 100% gold, definitely would have lost money in the last 2 3 weeks, because gold is going down. Most of the people, I mean, most of the central banks are selling gold currently. That's the reason for this fall to happen. And some of the people will completely exit their equity investments at the currently. They think they'll come back once the market starts to recover, and they definitely can't time that event when it will go up, and they'll definitely miss some returns. It would be better if you just stay invested, because even if you have built a perfect cheap valuation stocks portfolio, your portfolio will obviously fall in when everything falls, right? So, and it will recover better when your the stocks which you've bought are fundamentally correct. So you need to, build conviction and buy good investments, and you need to hold on to it, and you need to have the stomach to hold on to it during times like this. So definitely nobody can time global events like this. You just need to endure, and you need to stay invested, and you need to keep adding money, and you just need to see this as an opportunity to invest. Yeah, thank you, man. Uh, Thank you all for joining, and thank you. Have a nice weekend.